most people who are investors have stocks and bonds or annuities. And mutual funds can have all of them in it. It's just a mixture, but usually it's stocks and bonds, annuities, which own stocks and bonds, basically. So we went over those three main subjects. Now I want to go over one that's kind of arcane, and a lot of people don't understand it. And I'm going to try to be as easy to understand on this as I can. It's derivatives. Now most people, most investors, don't ever touch a derivative. But derivatives have been around a long, long time. Generations, basically, particularly in the farming industry, where one party, say the farmer, agrees to sell his goods, his livestock, his grain, his corn, to somebody else, which is known as the counterparty, at a certain price on a specific date. So why would a farmer do this? Because the farmer wants to hedge. He doesn't want to go out there and spend all this money growing his corn, only to have corn prices drop in the fall, and then he goes to sell his crop and he loses money. So what a farmer would do is make a contract in the spring to some other party that'll buy the corn to sell it on a certain date at an exact price. And that price is going to be pretty much determined by what the market is at the time. Now both parties, the party writing that contract is taking the risk. The party writing that contract actually think corn prices will probably be higher and he's going to make money because he's going to buy it lower. But the farmer says, I don't care if corn prices go up. I want to know that I can guarantee a certain amount of money on that date and know that I had a successful farming season. So that was the original use for derivatives, right? And a derivative means that the price of that contract is derived by another asset. In this case, it would be the price of corn. So the corn contract that these two people have, the value of it will fluctuate based on the price of the underlying asset, in this case, corn. Now you can have derivatives on almost anything in the form of what's called futures contracts. That's called a futures contract. In the future, something's going to happen. In the future, I'm going to sell you a certain number of bushels of corn at this price, and you're going to buy it from me on that date at this price. This is the contract between two parties. Now, again, there's always risk. Not risk to the farmer, because the risk to the farmer is that he sells his crop too cheap. Price of corn goes up, and that maybe happened to a lot of corn farmers this year who hedged their crops by buying futures contracts or actually selling futures contracts because corn prices are skyrocketing now because the crop had big failure. So a lot of these farmers who have these contracts, not only are they going to get less money for their crop, they're going to have less yield in their crop because of the weather issues that destroyed a lot of crops and made the prices go up. It's kind of like a double whammy to the farmer. Oh, geez, look at the price of corn now. At least half the crop that I finally got out of the ground, I would have been able to sell it for twice as much and make my money back, but now I have locked in a low price and I lost half my crop. And farmers are hurting. That's a whole other story. Another way you can buy a derivative is an option. Puts and calls. People have heard of options before, a put and a call. An option gives you the right to buy or sell a security at a certain price at a certain date. Same kind of like a futures contract. So if I think IBM is going to go up, say it's $100 a share, I could buy a call option at 100, meaning I have the right to buy it at 100 until whatever the term of the option is, till December, or till next January, or 1 month. There's all different options, dates, execution dates. Now, if I buy a call option, I'm betting that stock's going to go up. So if IBM goes to $110 a share, I have a right to buy a certain number of shares at 100. So I've just made 10% on my money. But it's not 10%. It's 10% if you own the stock. But the option may have cost you $1, and now it's worth $10. Because you have a right to buy it at 100, it's trading at 110, it's worth $10. If IBM went to 120, it's worth $20. So this is where the leverage is, and that's where the speculation is. Boy, I can make $1 go to 20. What's the percent return in that? 2,000%, right? Now, what happens if within that time frame, or by the expiration date of that option, IBM's 95. Well, that option has no value because you have a right to buy it at 100. I can go in the market and buy it for 95. I'm not going to buy your option. And you're not going to exercise it. So it can go against you, and now the option's worth 0, and now you've lost 100% of your money. Now, puts are the opposite. Puts give you a right to sell a stock at a certain price for a certain amount of time because you're thinking that it may go down. So if I have a right to sell X number of shares of IBM at $100 and IBM goes to $90, well, my option just went to $10. Just the opposite of the stock going up. So put buyers are betting that the stock is going to go down. Call buyers are betting that the stock will go up. And the value of that derivative, which is an option is a derivative, is based on the underlying asset, in this case, IBM stock. I know it can get complicated, and I'm trying to keep it as simple as possible. But they do have significant uses. The problem is the derivatives have been abused, and I'll talk about that in a second. They've gone away from their original purpose. Here's another type of derivative, and this is really what sparked the financial crisis in 2008. Credit default swaps. A credit default swap is an insurance contract, typically with an investment bank, where if I have $10 million of XYZ bonds and XYZ bonds default, the contract that I have will give me back all my money. So the counterparty who wrote that contract now is at risk for the default. Credit default swap. Credit meaning bond. Default meaning failure. Swap meaning who's going to lose the money. And that's what AIG did. AIG was writing this insurance against mortgage bonds back in the mortgage craziness of 2006, 7, and 8. And when the mortgage market cratered and those mortgage bonds defaulted, AIG was on the hook for tens and tens of billions of dollars, which AIG did not have. And that's when the entire financial system started to collapsing. And this is what's known in derivative contracts as counterparty risk. Now, I could buy that insurance on $50 million worth of bonds, but if the other side can't perform on that contract and can't make good on it, what's that contract worth? It's worth 0. And that's what a lot of the people that had these bonds who thought they were insured were looking at. They were looking at total losses, including big Wall Street houses like Goldman Sachs. AIG owed Goldman Sachs $16 billion in credit default swaps. Just one entity alone. So AIG was defaulting. And with that, defaults were going through the entire system. And we were looking at a systemic financial crisis. And if not for the bailing out of AIG and in essence Wall Street, because by bailing out AIG, that allowed Goldman Sachs to get their $16 billion back, as well as all other parties that had contracts with AIG. Isn't it so convenient, though, that they get bailed out? If it was you and me and we had a contract go bad, we wouldn't get bailed out. But that's the problem. The big banks now have used the derivative market to do massive speculation. And they're doing it in their FDIC taxpayer-backed bank entities. Now, it used to be, due to the Glass-Steagall Act from way back when, that investment banks had to keep their speculation separate from the FDIC-insured savings deposits banks. That way, depositors would never be at risk. But due to lobbying, and the investment banks on Wall Street has some of the biggest lobbying in Congress, and of course Congress is a bought entity, they changed the law prior to the 2008 crash that allowed them to use their FDIC branches of their investment bank, the actual taxpayer-insured one, to speculate. and putting all depositors at risk. And that's where we are right now. And do I think that this derivative thing is going to blow up again? I do. I do. Now, Warren Buffett notoriously once said that derivatives are a time bomb. They're weapons of mass financial destruction because they're so leveraged. And you wouldn't believe the trillions of dollars that banks have had in derivatives. Now, there was recently, the last couple of weeks, last week, there was a hearing on Capitol Hill about the Senate banking hearing. Happens quite often. And in that multiple-hour hearing where they had, the head of the SEC on and, all kinds of big wigs in banking, the word derivative never came up once. It's just amazing. There's $168 trillion in derivative bets concentrated at 4 mega Wall Street banks. But as you read through dozens and dozens of testimony, pages of testimony, the word derivative did not appear once. Now, I didn't say $168 billion in derivatives. I said $168 trillion in derivative bets. So these Wall Street banks have gone even further than they did back in 2008 as far as betting money, your money that's deposited in these banks, your money as a taxpayer who may have to come and bail them out again. And that's the thing, there's no consequence to that. They make all these bets and they're right. They make tons of money, they get great bonuses, and everything's fine. They make the wrong bets and they're at risk of going under. They're too big to fail, you see, because the whole system now can go down, including every depositor. And that's why the clamoring for bailouts. We're going to have martial law if we don't get them. And just realize everybody that's in the Fed, the Treasury, the SEC, they're all from the same place. They're all Wall Street people that just keep recycling in and out. And they take care of their own. And who was the U.S. Treasury Secretary in the midst of the 2008 financial crisis? None other than Hank Paulson, who's the ex-CEO of the Goldman Sachs that I just mentioned before, that were owed $16 billion from AIG. Hank Paulson goes over to Congress at night and basically said the whole system's going to fail unless you bail out AIG, which in essence was bailing out Goldman Sachs. You see how it works? Now, when you have a bankrupt situation like this, typically if there's anything left, you get pennies on the dollar on your contract. But no, Goldman Sachs and all the other cronies on Wall Street that had the counterparty trading with AIG got 100% dollar for dollar back, and it was your money. And since then, the Fed has just continued to prop up these banks to make them get bigger and bigger and richer at the expense of inflation, which we're all paying for it now and will continue to do. So that's derivatives. I mean, derivatives, and if you want to look at worldwide derivatives, they can't even quantify it. It's something like $1.2 quadrillion. Quadrillion. You know what a quadrillion is? It's 1,000 trillion. And a trillion is 1,000 billion, and a billion is 1,000 million, and a million is 1,000 thousand. Let's just say a lot of money. And the problem with derivatives, it kind of wires the entire financial system for risk. Because if one bank anywhere in the world fails on a $10 trillion bet, it wires through the system. They can't pay the next guy, and so forth and so on. And that's how you have contagion. That's how you have a small bank failing in Europe affecting Wall Street in 2 weeks. And Warren Buffett was exactly right. Derivatives, especially if they're misused, are weapons of mass financial destruction. They're hardly regulated. They're not very transparent on banks' balance sheets. So who has the most derivatives these days? Let's see here. Four banks with the most derivative activity hold 89.0% of all bank derivatives. Four banks. Those four banks are not the investment banking units of the Wall Street mega banks. They are federally insured, taxpayer backstop, commercial banking units of these Wall Street behemoths. JP Morgan Chase, number one. Goldman Sachs, Citibank, the federally insured unit of Citigroup, and Bank of America are sitting on a total notional face amount of $168 trillion in derivatives, or 89% of the $189 trillion derivatives at all banks. This is concentrated systemic risk on steroids and deserves an immediate separate hearing by the Senate Banking Committee to rein this in. They let it happen all over again. Now I'm telling you, when this time bomb goes off, it's not going to be pretty. And what it'll take to trigger it, who knows? Rising interest rates, there's something called interest rate swaps. There's all kinds of these things. If interest rates go up, I get paid from you. If interest rates go down, I got to pay you. Well, what if I can't? That's the problem. If I'm on the wrong side of a really bad bet, I can't come up with the money. I can't pay you. What happens then? That's when the system starts to fail. And that's when it'll be clamoring for more bailouts, more Fed printing of the money. So that's derivatives. I don't want to get too deep in it. I probably just scratched the surface on it, but I didn't want to teach you about it just because you're going to go out there and buy derivatives. You might invest in stocks and bonds and mutual funds and annuities. That's what the average person does. They don't go into the derivative market. I trade the derivative market sparingly. I'll buy options, puts and calls on stocks and so forth and so on. But I would never buy a futures contract. I would never buy a credit default swap or anything like that. That's what the biggies trade. But I wanted you to get an understanding of it because you hear about derivatives all the time, and especially when we go into a financial crisis. It's not the downturn of the stock market that takes the system down. It is the derivative time bomb going off related to the movement of those assets. And if the assets move slowly in small movements, the derivative markets function. It's when the markets move violently that all of a sudden some of these bets go off kilter, off the rails with you. And that's what we keep an eye on all the time. But it's unchecked, it's unregulated. The Senate Banking Committee doesn't seem to care. The average American doesn't even know that if they have an account at Chase Bank, that they may be part of a derivatives bet that will blow up the banking unit. And that's why I've been telling you, keep your money out of the Wall Street banks and keep them in the community banks. They don't have derivatives. And a derivative time bomb can go off overnight. That's how quick it can happen. You hear one firm's in trouble, and before you know it, they pile on in Wall Street, and then it pushes us into a significant problem. All right, so that's derivatives. I want to tell you about something that I experienced this week, and that people don't really know much about. They know a little bit about it. And what I did is, last fall I sold my boat. So I got $15,000 cash for it. When you do transactions for boats and cars, people tend to pay cash. All right. So I got an envelope with $100 bills in it, totaling $15,000. And I've had it in my safe, and I don't know. But I wanted to put it in my bank account. It's doing nothing in my safe, earning zero. I wanted to just get it into the system. So I go into my bank. I'm not going to say what branch or what bank. And I knew I was in for, at least, it's not a simple deposit, let's just say that. All right. So I go in and I walk into the bank, and I know the manager and I know the tellers there. And I walked in and said, hey, what kind of hassle am I going to have to deposit $15,000 cash in here? What kind of reports do you have to file on me? And the manager comes running over and says, oh, we're not allowed to discuss that with you. I What do you mean you're not allowed to discuss it with me? If you're going to file a report on me, I want to know about it. Maybe I'll decide not to deposit it. She goes, oh, no, we can't. We can't discuss anything that we'll do to you or with you. Now, I know, because I'm a financial institution myself. I'm a rep of a brokerage firm. I have to take anti-money laundering courses every single year. So I know what the process is, but I just wanted to see how they would react. And she goes, no, we can't talk about that. I'm sorry, I'm not trying to be rude, but I just can't tell you what's going to happen to you. I said, okay. All right, so I'm going to deposit it anyway, because I know what's going to happen. I said, you're going to do a CTR on me. She goes, I can't say that. Well, what did they do? As soon as they gave them the money, they called up the headquarters and started the CTR, the cash transaction report. Now, they do this whenever any cash transaction exceeds $10,000. And I understand why they're doing it. What if I'm trying to evade taxes? I have an ice cream truck, and I never deposit. Usually don't deposit the cash, but now I want to get in the system, and it's a lot of money. Or I'm a money laundering, or I'm a terrorist, or whatever. I'm a criminal of some kind. So if there's a pattern here of seeing people put cash into their bank account every day, the government wants to know about it. But usually it's $10,000 or more. Now, banks, government agencies, public corporations are exempt from doing this, and I understand why. I mean, they deal with a lot of cash. But banks do not have to tell you when they file a CTR at all. But I ask, and I'm looking at something here that's printed out on it, an article on it. It says banks do not have to tell you when they file a CTR unless you ask. Well, I asked, and they still wouldn't tell me. You can back out of the transaction, but that will result in something even worse. A suspicious activity report, a SAR. You don't want a SAR. A CTR is one thing, because there's nothing illegal about depositing cash in your account. But if you have a pattern of doing it, they're going to take a greater look at you. But a SAR is a suspicious activity report. And we'll talk about that in a second. So let's see. Okay, so $10,000 or more. They don't have to tell customers about doing it unless the customer asks. But if you ask, then it's a Sars. And I think that's why that branch manager who knew me was trying to say, look, you just can't talk about this, so she's trying to get me not to ask so she doesn't have to do the SAR. Now, they don't have to tell you if they do the SAR either, but I don't think they did. So they get on the phone with the headquarters there, and he's typing things into the computer as he's asking her questions. So I see he's doing the CTR. I know what he's doing. I've been through it before. They're asking me questions. What do I do for a living? I'm a certified financial planner. What does your wife do for a living? Why is that your business? Well, they need to know. All right, well, my wife's a homemaker. Okay, homemaker. Then he asked another question in the phone, and then he asked me a different question. Where'd you get the money? I sold a boat. Okay, put it in there. It took about 15 minutes, the whole procedure, to deposit $15,000 cash in your account. Now, some people say, well, why don't I just put in $9,000 today and 2 days later put $6,000 in? Sounds smart, right? You're not going over the $10,000 amount. No CTR has to be filed. No SAR has to be filed. Well, you're wrong. That's called structuring. That's called trying to get around the law by doing something that you think is smart, but is actually a crime. So we really don't know where all these reports end up. Currency transaction reports are reported to the Financial Crimes Enforcement Network. You ever hear of that? FinCEN? Well, I know of FinCEN because, like I said, I take courses and test on this every year. It's the Financial Crimes Enforcement Network. They look at all these things and they're looking for patterns of tax evasion, of terrorism, of money laundering, and so forth. So now, what about the suspicious activity report? What is it, and what you need to know about it? A suspicious activity report are used to make financial authorities aware of transaction behavior that seems out of the ordinary. That might be a precursor to a crime, or might threaten the safety of the public. Suspicious behavior around bank accounts and other financial services is often an indicator that clients are involved in money laundering, the financing of terrorism, or fraud. And Sars filing is a priority compliance obligation for financial institutions. And again, nobody can come into my office and try to put money into their brokerage account by giving us cash. We just don't accept it. So we don't really have to file, it's a cash transaction report because we don't take it. But we could file Sars reports based on certain activity within an account. Wire transfers of money back and forth and things like that. A suspicious activity report is necessary whenever a financial institution detects a potential suspect transaction from one of its clients. When that suspicious activity is detected, the financial institution has around 30 days to confirm and submit the SAR. The period may be extended to 60 days if more evidence is required to support the document. Circumstances which might trigger a SAR include transactions over a certain value, international money transfers over a certain value, unusual transactions or account activity. An example of a situation where a SAR would be necessary: consider a customer who deposits the same amount of money in their account on a monthly basis. If that customer suddenly started to deposit and withdraw large amounts of money on a weekly schedule, that behavior would merit suspicion and trigger a SARS report. Now, you're not going to be told about a SARS. You're not even going to know what was filed on you. When SARS are filed, the subjects of the reports are not informed, and discussions of the SARS with third parties like media organizations is legally forbidden. So you don't want to you get one SAR, that's one thing, they're going to start looking at you. You get two SARs, you're going to start getting knocks on the door. So don't think that you're smart, that you could structure it by just doing a certain amount here, a certain amount there. If you've done it legally, there's no reason for suspicion, you didn't commit a crime, you're not money laundering, you're not terrorism, feel free to walk into the bank and deposit cash. You're going to have to answer a lot of questions, but if it's above board, you do what you got to do, right? Now, it makes sense that when you're depositing money into an account, the government could be suspicious on where it came from and it hasn't been properly taxed. But what happens if you take money out of the banking cash? Instead of depositing $15,000, I got $25,000 in my savings account or checking account, and I walk into the bank and say, I don't want a check from you. I just want the cash. I'm going to put it wherever I want to put it. I just want to do a withdrawal, $15,000 cash. First of all, the teller's going to turn green, going to get the branch manager. The branch manager is going to pull you in their office, and they're going to say, what are you doing? I go, well, I have $25,000 in the bank. I want 15 of it. It should end right there, right? No. Well, what are you going to use it for? Well, it's none of your business what I'm going to use my money for. Oh, yes, it is. Because if you don't tell us, not only are we going to file a CTR, which we have to do anyway, but we're going to file a SARS on you. Now, this is your own money. This is not depositing money where did it come from? This is money that's already in the bank. They want to know what you're going to do with it, which I find to be outrageous. And by the way, these banks don't have a whole lot of cash in there, so if you're going to take a lot of money out, call them up. It may take 4 days before they'll be able to satisfy you. I mean, give the bank a break. I mean, you think your money's sitting there in the vault. It's not there. It's gone. It's been lent out 10 times. But even if you wanted $100,000 cash and you had $100,000 in the bank, you can get it. But the bank will have to have a Brinks truck come, with a ton of cash to give it to you. And by the way, there'll be some pretty significant SARS report filed on you. But you can want the money for anything. You want to go buy some gold. Or maybe you want to keep it in your safe because you don't trust the banking system. what they want to know. And I was blown away. The first time this happened to me 20 years ago, I couldn't believe what I had to go through to take money out of the bank. It was a lot harder to take it out than it is depositing it. But to hear all these reports had to be filed on me because I just wanted my own money blew me away. So, don't be afraid to do it. Just be careful. Just be aware of what's going to happen to you when you deposit or take money out of the bank. And that's why I don't keep a whole lot of money in banks. I just don't want to have to fight to get my own money, out of a bank. Let's take a break. 732-505-1160 is the call number. My name is Lou Scatigna. You're listening to The Financial Physician. Don't go away.